Mike, like many of us, wants to invest in the stock market but feels lost. Every time he looks at stock charts, listens to financial news, or hears his friends talk about investments, he gets overwhelmed. It all seems confusing. But one day he asks himself, how do successful investors like Peter Lynch make millions without getting confused? That's when Mike discovers Lynch's simple investing rules. Rules that anyone, even a beginner, can follow to build wealth over time. Peter Lynch didn't just succeed in the stock market, he mastered it. As the manager of Fidelity's Magellan fund, he turned it into one of the best performing funds ever. The best part? He didn't rely on complicated formulas or tricks. Instead, he followed simple rules that anyone can use to invest wisely. Mike realizes that if he follows these rules, he too can build wealth over time. Let's follow Mike's journey and learn the 5 golden rules that made Peter Lynch a stock market legend. 5 golden rules for winning in the stock market. Number 1, invest in what you know. Mike always sees his friends and family using Apple products, drinking Starbucks coffee, and shopping at Walmart. But it never occurred to him that these companies could be great investments. Lynch's first rule is simple. Pay attention to the products and services people use every day. Lynch famously invested in Dunkin' Donuts because he saw that people loved their coffee and kept coming back. He realized that a company with loyal customers would likely be a good investment. How Mike applies this rule. Mike starts paying closer attention to his surroundings. He notices his younger cousins love shopping at Nike. His parents always choose Costco for groceries. His friends watch shows on Netflix. Every coffee shop he visits is packed with people ordering Starbucks drinks. Instead of picking random stocks, he starts researching these companies to see if they are financially strong or not. Key takeaway: the best investment ideas are often right in front of you. If you see a company's products being used all the time, it might be worth looking into as an investment. Number 2, do your own research. One day, Mike's friend tells him about a hot stock that is supposed to do really well. Mike feels excited, but then he remembers Lynch's advice. Never buy a stock just because someone else says it's good. Always do your own research. Many people invest in stocks based on rumors, social media hype, or advice from friends, but without understanding the company, they might end up losing money. How Mike applies this rule. Instead of blindly following his friend's tip, Mike researches the company by checking sales and profits. Is the company making money or not? Then growth rate. Is it growing over time? Also, competitors. Does it have an advantage over similar businesses? Mike realizes that investing is like buying a business. You wouldn't buy a bakery without knowing if it's making money, so why do that with stocks? Key takeaway: never invest in something you don't understand. Always check if a company is financially healthy before buying its stock. Number 3, choose simple businesses. Mike finds a new biotech company that claims to be working on groundbreaking medicine. But when he tries to understand their business model, it's full of complex terms and confusing details. This reminds him of another rule from Peter Lynch. If you can't explain how a company makes money in one sentence, it might be too risky. Lynch preferred investing in businesses with easy-to-understand models, like McDonald's, selling burgers. Simple. How Mike applies. This rule: Mike looks for companies with clear business models, like Coca-Cola sells soft drinks, Nike sells shoes and sportswear, Disney makes money from movies, theme parks, and merchandise, McDonald's sells burgers and fries and people love it. He avoids complicated businesses because if he doesn't understand how they make money, he won't know when to buy or sell. Key takeaway: stick to companies with simple business models that anyone can understand. Number 4, don't try to time the market. Mike often hears people say, the market is going to crash, or This is the best time to invest, but Lynch warns that trying to predict market ups and downs is almost impossible. Instead of guessing, it's better to invest regularly and hold on to good stocks for the long term. How Mike applies. This rule. Mike invests regularly, every month for example, and focuses on the long term. When the market drops, he sees it as a chance to buy stocks at a lower price, rather than panicking. Key takeaway: don't try to predict the market. Invest regularly and think long term. Number 5. Be patient. Wealth takes time. Mike used to check his stock portfolio every day, worrying about small price changes. But Lynch compares investing like planting a tree. Checking it every day won't make it grow faster. How Mike applies. This rule. Mike stops worrying about short-term stock movements and learns about companies like Amazon, where early investors who held on to their stocks for years made big gains. Key takeaway: investing is not about making quick money. It's about buying strong companies and letting them grow over time. Now let's understand 5 biggest mistakes investors make. Number 1. Buying without understanding the business. One of the biggest mistakes an investor can make is purchasing a stock without fully understanding how the business works. It's easy to get excited when you hear about a hot stock or a popular investment, but if you don't know how the company makes money, you're taking a big risk. If you don't understand the business model or the industry, how can you accurately know its potential for growth or profitability? For example, many people jumped into cryptocurrency without fully understanding how blockchain technology works and ended up losing money when the market crashed. Always take the time to research the company and understand its operations before investing. Number 2. Chasing hype and trends. In today's world, it's easy to get caught up in the hype when everyone is talking about a particular stock or trend. But by the time the news is everywhere, it's often too late to invest, as the stock is already overpriced. Chasing trends can lead to buying stocks at their peak, and once the hype dies down, you may find yourself holding a losing investment. For example, Dogecoin saw a huge surge in value when it was trending online, but after the excitement faded, its value crashed. Instead of following the crowd, it's smarter to stick to your research and buy stocks based on their long-term value. Number 3. Ignoring company fundamentals. Many investors are drawn to companies because of their flashy brand or recent success. However, if the company is struggling financially, with too much debt or poor earnings, it may not be a good investment. The company's fundamentals, its financial health, are more important than its name. For example, you wouldn't invest in a lemonade stand that consistently loses money. If the company is not making profits, managing debt poorly, or showing no clear path to growth, it's likely not a good investment despite its popularity or brand recognition. Number 4. Selling too early. Many investors panic after seeing small gains and quickly sell their stocks to lock in profits. But what if you had held on to those stocks for a few more years? You could have seen much bigger returns. The key to making money in the stock market is often holding on to investments for the long term. Selling too early means missing out on potential future growth. For example, if you had sold Tesla stock in 2015 when it was just $30 per share, you would have missed out on the massive gains it made in the following years, as it grew into one of the most valuable companies in the world. Number 5. Panicking. During market crashes, the stock market can be volatile, with prices going up and down. During market crashes or downturns, many investors panic and sell their stocks in a hurry, thinking they're avoiding more losses. However, selling during a crash often means you lock in losses. The smart move is to buy when prices are low and hold on to your investments long term. For example, during the 2020 market crash, many savvy investors took advantage of lower stock prices and made huge profits when the market recovered. If you panic and sell, You could miss out on those opportunities. Conclusion of Peter Lynch's Golden Rules. Invest in what you know, do your own research, choose simple businesses, don't time the market, be patient, and think long-term. And avoid these mistakes. Don't buy without understanding. Don't chase hype. Don't ignore company fundamentals. Don't sell too early. Don't panic during market crashes. Peter Lynch didn't need fancy tricks. He followed simple, time-tested strategies. Now you can do the same. Hit the like button, subscribe, and let me know in the comments. What's your favorite investment rule?